Aloha, inspired moneymaker. Thanks for joining us today. If this is your first time here, welcome. And if you're a returning viewer or listener, welcome back. It's always great to get together. This episode is investing in real estate opportunities and considerations for wealth building. I hope that our guests will share their insights about real estate investing strategies, financing options, market analysis, legal tips, and property management. We've assembled an impressive panel who can share real-world experiences. Make sure you tune in to the end because we're going to dive into specific strategies that can help you maximize your profit, protect your assets, and grow your wealth through real estate. So whether you're a seasoned investor or just getting started, I think that we're going to cover something for you. Before we jump in, I should introduce myself. I'm Advisor Andy, financial advisor at Runnymede Capital Management, and this episode is brought to you by my investment firm. I want to invite you to take advantage of our 3-minute financial plan. Head over to inspiredmoney.fm/getplan. It just takes 3 minutes, and I can tell you that you can get a personalized snapshot that will help kickstart your financial journey. So just take 3 minutes. A little planning can go a long way. Now let's welcome in our incredible panelists for today's discussion. We have Kathy Fettke, CEO of Real Wealth Network, best-selling author of Retire Rich with Rentals, and host of the Real Wealth Show and Real Estate News for Investors podcasts. Kathy has been featured on CNN, CNBC, and Fox News, sharing her expertise in building wealth through real estate. Kathy, welcome.
Thank you.
Yeah, I'm excited that everybody is here. We have Joseph Gozlan here. He's a commercial real estate broker, author of the Real Estate College Fund, and managing partner of EBG Commercial Management with over $30 million in acquisitions and extensive experience in multifamily and industrial properties. Joseph will bring some deep insights to today's conversation. Joe, so glad that you made it.
I'm glad to be on the show. Thank you for inviting me.
We have Dana Dunford, CEO and co-founder of Hemlane, a property management platform that helps real estate investors manage their rentals from a distance. Dana is a strong advocate for smart technology-driven property management and will share her expertise in keeping your properties running smoothly. Dana, welcome.
Thanks so much, Andy, for having me.
Yes, and this is her, not her typical podcast setup. She's in the Calgary office of Hemlane, and I think it's looking pretty darn good. And then we have Rob Abasolo here. He's known as Robuilt on YouTube. He's a real estate investor and content creator specializing in short-term rentals, having built a successful portfolio of Airbnb properties across the U.S. Rob, so glad that you made it.
Ahoy. Thanks for having me. Excited to be here.
So this is great. I think that each of our guests brings a little bit different perspective under this umbrella of real estate, and hopefully we can have a really interesting and valuable discussion that will teach us all about building wealth using real estate. Let's jump right into segment 1.
Investing in real estate offers diverse strategies, each tailored to different investor goals and risk appetites. For those focused on long-term wealth, buy and hold involves acquiring properties to benefit from rental income and appreciation over time. It's a path to steady cash flow with tax benefits and potential capital growth. If you're after quicker returns, fix and flip might be your style. This approach involves purchasing undervalued properties, renovating them, and selling for profit. While returns can be high, this method demands market savvy and hands-on project management. Real estate investment trusts, or REITs, offer a more passive route. By purchasing shares in real estate portfolios, investors gain exposure without the demands of property ownership. REITs provide liquidity, dividends, and diversification, but are sensitive to stock market shifts. Ultimately, the best approach depends on your financial objectives and how involved you wish to be in managing your investments. By weighing these options, you can align your strategy with your personal investment vision.
Joe, can you kick us off? You've built a substantial portfolio in multifamily properties. What drew you specifically to this asset class over other strategies? And was there a defining moment that made you realize that this was the right path for you?
Yeah, well, here's the thing. I started in real estate like everybody else with the Rich Dad Poor Dad when I was just out of college, and it sounded awesome. And we started investing with single family and a couple of duplex and all that. And everything was going okay, but wasn't as excited as I thought it would be. It wasn't really making money. I had a whole career in software before I transitioned to real estate. And then somewhere around 2015, I had a time where I had a foundation issues on one of my properties. An AC went out on another property, a fence that we needed in another property. And I felt like, well, I wrote about $45,000 worth of checks in 6 months. And that just was not scaling. So I said, okay, what else is out there? How can I scale to something that makes more sense? And multifamily was the answer back in 2016.
That's great. Kathy, I'm curious because real estate, I understand that like many people, you thought that you had to be wealthy to get started. So can you talk about your experience?
Yeah, I think most people understand that great wealth can happen through real estate, but you think you got to have the down payment and you've got to, have the credit and so forth. And that is true if you want a conventional loan. When I started, when I started investing, I should say it was 2005, where, believe it or not, you could get an unlimited number of investment properties with no money down and sometimes money back. So it was a little bit easier for me to get started because I did have good credit, but I also found out that you can hire companies to help you keep your credit good and improve it. So for me, I tried all kinds of things. I did invest in a couple of apartments. We have done a lot of build to rent and, residential communities. But still, for some reason, my favorite is just the good old buy and hold single family property. I like to find areas that have tremendous job growth and population growth and infrastructure growth. When these things are in place, that attracts people and they need housing. And I've found that just buying a house and putting a renter in there, you can double, I don't even want to say double your money. The property can double in value in just 5 years. But if you put just 20% down, you've made quite a substantial gain.
Is that appreciation just gravy? Like at the outset, how are you thinking about, what's your approach?
Well, appreciation is speculative, right? You never know how much a property is going to increase in value. But what I found over the past 25 years, so I've got some experience here, is that if you get those things right, if you're really in an area that's in the path of progress, where you've got a city like, let's say, Dallas, North Dallas, where we've been investing, we have a single family rental fund in Sherman, Texas. There's billions of dollars pouring into this little tiny town, and new freeways, new hospitals, schools, and just not enough housing. And it's hard, even in Texas, to build enough housing to keep up with that kind of demand. So over time, those properties double. Now, because we started the fund 2 years ago when the housing market sort of came to a standstill, when rates went up, we've already doubled the value of those properties. But if you're putting 20% down and you're doubling the value of the property, that's a pretty good return.
That's a great return, and it definitely helps when you have a rising tide lifting all ships.
Yes.
Rob, I said Robuilt. Since your name is Rob, is it Robuilt?
It is Rob Built. I wasn't going to give you too much of a hard time on your own podcast, but yeah, it's Rob Built.
That makes total sense. It dawned on me after I said it. Now, can you share your story about how you scaled from your first rental to where you are today?
For sure. Yeah. I got started, 7 years ago. I was a working professional. This was back in the day when I was living the corporate America life. I was a copywriter at an ad agency. And really the way I fell into real estate was more on accident than you'd think. I just wanted to subsidize my mortgage. And I started by buying a house. I put 3.5% down using an FHA loan. And I rented a room to my friend. I had a wife she's still my wife, but she was also my wife, but I had to pitch her, right? I was like, hey, listen, if we have a friend live with us, that can knock down our mortgage, $700, $800 a month. and we can save that for you. And so really for me, getting started in the world of real estate, for really the first 2 houses that I bought them as primaries. That first primary home that I purchased appreciated $40,000 in the 3 years that I owned it. I sold it, used that money to buy a house in LA a couple of years later. I house hacked. And from there, I kind of just found myself into short because I told myself I could rent a room as a long-term rental to a friend. I could also the internet through Airbnb, and that ended up being a lot greater return for me. And so that kind of turned me into the world of rentals and kind of scaled from there.
Rob, I think we're getting a little issue with your mic. I'm not sure. You were fading out there, and I'm not sure why that was happening because you have a very nice mic there.
Yeah, let me check my settings. I think I should be
You're
okay.
good now.
Oh, it's improving.
Okay. Oh, here. What if I turn this up a little bit? Is that any better?
Now you're getting louder. Yeah, that could work.
That's what we want on a podcast, right? For me to be heard.
Yes, that sounds good. So Dana, tell us your story. How did you get into the technology side of building this platform that can help investors to better evaluate potential markets and then also to do remote investing?
Yeah, absolutely. Would love to tell my story. Just before I do, I have some really strong opinions based on what everyone has just said.
All right.
And want to kind of emphasize it because this started out with you can invest in REITs, right, as one of the storylines that was initially brought up in the video. And I saw a Twitter post actually yesterday. And it basically said that if you invested $500,000 in real estate 15 years ago and sold your house now for $2.5 million, you would have still underperformed the S&P 500. And I think what that is failing to miss, as well as REITs or any of these other investment strategies that are on the real estate side that are not direct investments, where you yourself go and directly purchase a single family home or multifamily, is 2 huge things. One is leverage, one is taxes. And those 2 can change the game for you, as Kathy had mentioned, in her case of having that leverage, being able to put 20% down and grow your portfolio through leverage. And so the reason I bring that up is, how I got started in real estate was honestly 2010. So a really lucky time to get started in real estate. I was working at Apple, so doing new product launch introductions. Older sister lived in Denver. She was purchasing investment properties, said, hey, do you want to get involved? Anyways, fast forward to now. Now my husband and I invest across the nation as well. And one of the things for me is the best investments are not in your backyard. And so if you think about it, if you were to say, hey, I can only invest in companies that are in my backyard, you're probably not diversified. And while I don't recommend buying like 5 homes in 5 different states, right, when you get started, I do think there is something to say as you build your real estate portfolio as an investment strategy that going into different markets and A/B testing makes a ton of sense because you can very quickly make sure that all your eggs aren't in one basket. And so that was really out of passion of helping others invest in real estate. That was really the impetus of looking at technology and saying, how do you give someone on their phone a way to manage their rental property from anywhere and have full transparency and control over it? And that just didn't exist in the market. It was basically, do everything yourself. 72% of people self-manage their properties. I don't recommend that. It's a lot of work, or the rest do full service traditional management. And so we created something that was basically everything in between, where it's a plug and play. You can choose which leasing agent you want to work with. You can choose a repair coordinator, all of these different things to just provide a better experience. But I think, to kind of get after the theme and point here, real estate is something where you can make a lot of money in it. You can also lose a lot of money in it very quickly. So you have to do your diligence. It's a lot of work up front. But again, you're using leverage and taxes to your advantage. And once you get something set up in place, it becomes a whole lot easier.
Maybe we can just do a quick round robin. Who is self-managing? who is hiring a management company, or are you doing something in between? Maybe Dana first. Oh, she's coughing. So Rob first.
I'll go first. Yeah, I still self-manage. I still get every single message. I've got about 40 units or 40 to 45 out in the world right now. Every single message that comes in on the Airbnb platform, Vrbo platform, I get all of those. I do have some people on my team that assist with it, but I'm still pretty in the trenches here in the self-management side of things.
Yeah, it's interesting. I self-manage my short-term rentals, but we have property managers for our long-term. But for tax reasons, that can be a better thing to
Definitely. Yep.
Yeah.
How about Joe?
Yeah, so we actually have a commercial property management, and we self-manage our commercial properties, and we manage for others the commercial properties. But funny enough, my single-family properties that I still have, those are managed by third party.
And Dana.
So, Andy, that sounds about right. 72% self-managing. I think this audience here, or sorry, the panel here is pretty aligned with that. So I self-manage, but it's through Hemlane. So through repair coordinators, leasing coordinators, anyone who can do the administrative work. And I think to Kathy's point there, the reason that you will want to self-manage is tax reasons. And Rob, I think very similar on your side as well. There's a lot of tax statuses like real estate professional status you can get where you would have to put some hours in yourself. And so I think from that perspective, like doing a hybrid model where administrative stuff you're not doing, but then you're making the decisions and still considered the manager is a win. And basically the future, when you think of real estate investing in the future, I think the convenience culture has really lended towards that and that trend.
Anybody else want to weigh in on this one before we move on? Okay, let's go to segment 2.
Financing real estate investments involves several pathways, each with distinct advantages and challenges. Traditional mortgages offer stable, long-term funding with lower interest rates, but they often require substantial down payments and strict credit qualifications. On the other hand, hard money loans are ideal for quick access to funds, particularly for short-term projects, though they come with higher interest rates and fees due to their asset-based nature. Private financing offers flexibility and customized terms, appealing to those with non-traditional financial profiles. However, it can be costlier and depends on finding willing lenders. Self-directed IRAs allow investors to use retirement funds to invest in real estate with tax benefits, though they come with complex regulations and restrictions on transactions. Choosing the right financing option depends on your investment strategy and financial situation. Whether seeking long-term rental income or short-term gains, aligning financing with your goals will help set the foundation for a successful real estate venture.
Kathy, you mentioned that when you started, you could have zero down or even get cash back. What do you advise new investors on choosing between a traditional mortgage, hard money loan? Like when you're starting out, where do you go?
Yeah, it depends on your situation. If you're starting out and you have a good job, you have great credit, you've got some savings, maybe you've got some money in the stock market and you're overinvested there and you want more of a hard asset that cash flows today, then you're in a different position than somebody who has no money, who's just starting out in life. So you're going to have completely different strategies. For the professional, which is who we work with at Real Wealth, because we're from the Silicon Valley, we would see all these really busy tech workers who, were making lots of money, but still having a really hard time building wealth because it's so expensive to live in Northern California or California in general. We created a solution for them. Like, let us help you invest in turnkey properties nationwide with property management in place. So all they have to do is get the loan, and they could probably qualify for it if they've got the job, the 2-year job history, plenty of reserves, good credit, and so forth. So that's a little bit more on the passive side. Then we also offer completely passive, which would be syndications, where we just do all the work and you just invest, but you do need to be accredited. But for somebody starting out, there's lots of opportunities too. And this is what frustrates me is like people don't realize that they can get in the game. They don't have to have all that money. You can get your first home with 3% down and house hack. That's how we did it. We were able to rent out rooms in our house, just like Rob said he did. And, actually, we're still doing it today. We still have 2 Airbnbs on our current property that pretty much pays for everything. And for our lifestyle here in California, you can learn how to flip. And if you learn how to do that, or get a mentor, get a partner who can show you how to do it, there are lenders who will lend 100% of the deal if there's enough equity in there, if there's enough upside. So you can wholesale, you can find a deal with seller financing. So I really want the audience to know that there is absolutely no excuse for not jumping in, whether you have money or you don't. There's something for you. You just have to get the right education.
I don't know if Dana was raising her hand. I saw her smiling, so I want to see if you had something to add.
No, I was smiling because of that. And what I love about it is, like, you don't need the capital right up front, and house hacking is definitely something that I'm a huge proponent of. And then, as Kathy said, the second that you start considering your current assets that you have in properties as a way to generate more income, you might do a strategy that's short-term and long-term, right? Some of your properties may be long-term. Maybe there's a house on your current land, or like where your current primary residence is, that is a short-term vacation rental. I think there's a lot of creative things that you can do to generate that wealth. And then again, obviously the tax side, I think, is a really important one, especially if one of you, between you and your significant other, has a W-2 job.
Mm-hmm. Rob, can we go to you? Because it sounds like you've had short-term, mid-term, long-term. Maybe you can talk about, especially the short-term rentals, like what financing options have you found most effective, especially when you want to grow
for sure
faster?
I think there's a few different ways you can do it. I mean, I would say the 3 or 4. I mean, I have pretty much at this point tried every financing option. I have done, a primary residence loan, an FHA, and lived in it as a primary and rented out places on the property while I lived there, and then converted it into a rental like years after the fact. I've also done second home vacation, or second home loans, or vacation rental loans. That requires 10% down for you to do that. Couple stipulations that you have to abide by if you're going to do that. Typically, lenders like to see that you're going to be actually vacationing, right? It is a vacation home loan at that property for 14 days every single year at a minimum. Very easy to do, because the premise of short-term rentals is that you are buying vacation homes that other people pay for, that you get to enjoy on the side. I've also done creative finance strategies where I've taken over payments via sub-2, a subject to transaction. And one of the more recent ways that I have financed a short-term rental is actually 100% seller finance. The seller wanted a 10% down payment, financed it to me at 3% just under a year ago, with a loan term of 30 years. So that one is obviously my favorite. I don't really like dealing with banks if I don't have to. Seller financing is its own gold mine in and of itself. But I mean, I would say I've tried it all. And for me, the simplest and kind of easiest way that I've sort of uncovered, I think, has been the creative finance route.
Any mistakes to avoid since you've experimented with everything?
Yeah, I think a lot of people, they try to get very creative with breaking into short-term rentals, and it's a very like a dreamy asset class to be in. And so because the cash flow is so high, I think it just gets a lot of people to run full sprint towards short-term rentals. And I see a lot of people that are like, they get really sneaky with it, and they're like, oh yeah, I'm just going to use an FHA loan to buy, I'm going to use a first home loan to buy my short-term rental. And like, I only need 3% down. That's what we call mortgage fraud. So you definitely don't want to do that, right? Like every single loan, every single mortgage has very specific guidelines and rules that you want to abide by. So I would just say, make sure that you're actually using a loan product that is that makes sense for the use case of it. So don't tell the FHA commission that you're going to live in it if you plan on Airbnb-ing it. That could land you in some pretty hot water. And I've luckily stopped a lot of people from doing that in my career. And I wish I could say that number decreases every year, but people always, they feel like they're pitching me this really crazy new idea. They're like, hey man, did you know you can put 3.5% down? I'm like, no, you can't. So that's probably the number one mistake that I would probably tell people to avoid.
So follow the law. Follow the law.
Yeah.
It's a good tip in general. Stay out of prison. Like it's what our mom taught us.
Good advice. Good advice. Joe, can you comment on the financing landscape for multifamily properties? I imagine it's changed with the current economic environment, and I'm wondering how you're adapting.
Yeah, absolutely. So we do a lot of commercial with our clients, and it's not just multifamily. It's also retail and industrial, and those loans are different than the agency debt that you would get for multifamily. But yes, very much like everything else in real estate, interest rates went up in late 2022, and things became a little bit more challenging. Luckily, in commercial, creative financing, seller carrying a second note, and other solutions are more common and more acceptable than somebody selling their own home and have never heard about seller financing. But I just wanted to kind of reemphasize what said at the beginning of the segment. I think the best and the biggest financial impact that a young person can have is doing house hacking, whether it's lending, getting roommates, or getting a duplex, fourplex kind of property where they can rent the other units. Best financial impact you will have on your life. We had a client a few years ago, 26-year-old software guy, bought a duplex, moved into one side, rented the other one. A couple of years later, he moved out. At 26, 27 years old, not only he was a homeowner, he also had a rental unit. And how many of these people do you know? And all he had to do is put like 5% down to get into it. So I think that is probably one of the biggest financial start to somebody's life if they're going to go that route.
Does it take a little luck to have like a good experience on the first one? Because I feel like we all know somebody who tried to rent out, and then many people say, this is the greatest thing ever. I want to do it again. And I want to just keep repeating that. But others have said, oh my gosh, that was the biggest nightmare. I never want to do that again. So any advice on how to put your best foot forward and increase your odds on the first time?
Yeah, so really not trying to win it is a good idea, right? There's a ton of resources online, whether it's on YouTube or online. Bigger Pockets is a fantastic resource, and they can teach you how to get a tenant and how to screen and what to look for and so on, and not just trust anybody that says, yes, I got a high-paying job, and you don't verify income, or you don't call the previous landlord to make sure that they didn't leave holes in the walls. So do your work up front, hire a professional. Even if you do, like, for example, a duplex and you're going to lease the other side, maybe hire a professional property management to help you with the first year, just so you learn from their experience. But I think educating yourself and learning is the best way to do that. And then the other side of it is, you know what? No matter how professional you are, it will happen at some point. It's going to be really bad luck if it's the first one, but hopefully it's not the first one, but it will happen at one point or another. I'm sure everybody on this panel have horror stories that happen somewhere along their career in real estate, right? It's part of the business, because we're not in the building business, we're in the people business.
Does everyone have horror stories?
Oh, which one do you want?
Yeah. I have horror stories just from today, I think.
Yeah, too many.
Yeah. I mean, the way that you reduce risk is just making sure that you either have experience or you are working with someone who has experience. There are ways to protect yourself in real estate under getting a good inspector, getting a good appraiser, knowing the area, what are the crime rates, if you're in a high crime area, there's a better chance that your house is going to get broken into or something's going to happen. So really understanding, the more information you have, the better. But at the same time, that could lead to analysis paralysis where you don't do anything. So I think I agree with everyone here that understanding that you win some, you lose some, you just really need to win more than you lose.
Anyone want to share a horror story? Anyone brave?
Oh
I-
man.
I mean, so
Yeah,
many.
go ahead, Dana. Yeah.
I have a pretty good one. Speaking of build to rent is very popular these days. And so gave a developer some money, and fast forward 3 years later, never had to sue someone, but definitely had to sue someone in this case to get the money back because the property was never built. And why I bring up that story is that you're always going to have something go wrong. And it's at different points in the life cycle. It usually actually happens pretty early on. And then, as Kathy said, you educate yourself, you work with a mentor who's been there and done that to help reduce that risk. And then over time, it gets better and easier. And you almost have a playbook. Like, you have who you're going to go to for what part of the life cycle. And it makes it so much easier and so much smoother, which is why we're all here. We're passionate about making sure others don't make those mistakes. But I do think that you just have to get into it first, knowing that it's going to be a huge time investment at the beginning to get things set up. It's going to be a lot of education up front. But in the end, when you look back on it, I've been in it for 15 years now. Looking back on it all, it totally makes sense why you should invest in real estate. And because it's hard, not as many people do it as they should. And there's that huge opportunity for you with leverage and taxes. So yeah, I would say that was my horror story. And it actually turned out to be a good story because of the interest on it. And I obviously took the person to court, the developer, and won. It was very clear in the contract that the property was never built. But you will have certain stories like that. And it can get you down, but you just have to keep going and learn from the mistake and not make it again.
Anybody else?
I mean, I've got horror stories, but they all pertain to hosting, crazy things that have happened at my rentals. But I think my philosophy is like, it's not so much about the horror story itself. I mean, if you think about it, like the greatest skateboarders in the world, like Tony Hawk didn't quit after he broke a bone, right? Like, he healed up, got back on the skateboard, and went on to become the greatest skateboarder of all time. I kind of think that's just the way real estate is. It's like, we're going to have broken bones, bruises, and how willing are you to come back to the game after you've healed up? Or are you even willing to heal, right? I think a lot of people get so scared at sort of the little things coming up in their first rental that it causes them to never actually go and buy another property. I think the skill to develop is not necessarily just how to avoid the mistakes, but how to develop the thick skin to where they don't bother you. Because I've hosted tens of thousands of people at people at my properties. Nothing really phases me these days. One time I was having wine with my neighbors. It was the first time my neighbors ever came over to our house, and we were having a good time. We were vibing and, like drinking some wine, having a good time. And I get a phone call, and my assistant, she's basically like, "Hey, there's a manhunt at the property, and the cops are like looking for a perpetrator." And I was like, "Oh, okay, well, cool. Like, let me know how it goes." And then I get off the phone and I sit down at the dinner table, and like, my neighbors were like, "What happened?" I was like, "Oh, just there's like a manhunt. They're looking for someone that was at my property." And they're like, "What? Like, that's it? Like, you're not going to acknowledge how crazy that is?" And I was like, "Oh yeah, I guess that is kind of crazy, but I know I'm not going to fly out to West Virginia from Houston on a random Thursday night, And so it's like, you just have to kind of understand that every situation you can't avoid everything, but you can put teams in place to help you manage those situations. And kind of the final note on that story, there was no perpetrator. The guests walked into the house, they flipped the light switch that turned on a room on the other side of the house, and so they thought that there was someone in the house, and they got all freaked out, and they called the cops, and K9 unit came out, and oh man, yes, so that's Airbnb in a nutshell. You sure you're ready for this?
I love it. So perseverance and resilience, you're going to build very strong muscles on those two fronts.
100%.
Yeah, well, but that's true to every investment. Honestly, if you invest in stocks, you think everybody had a perfect score between 1980 and now. They all saw a downfall and everything else. Every investor vehicle has ups and downs. Real estate is not different. It's just that ours get to be a little bit more vivid than, oh yeah, the stock plummeted. We have stories like we manage hundreds of C-class apartments. I'm holding back because I'm pretty sure YouTube would want to keep it PG-13. So, yeah.
Yeah, definitely. I think with stock investing, it's inevitably a series of mistakes, and you're just trying to limit the mistakes. And if you limit your mistakes enough, then you can be one of the best investors in the world. Let's go to segment 3.
Thorough market research and accurate property valuation are essential steps in real estate investing. Understanding factors like location, supply and demand, and economic indicators can greatly influence investment outcomes. Location affects property values, with areas near amenities and quality schools generally seeing higher demand. Analyzing supply and demand gives insight into market health, while economic factors like job growth can signal potential for property value increases. When valuing properties, comparative market analysis compares similar properties to estimate fair market value. The income approach, focused on rental income, uses the cap rate to assess profitability, while the cost approach looks at replacement costs, often for unique or new properties. Market dynamics also play a role. Real estate cycles, interest rates, and local regulations impact buying and selling decisions. Timing purchases with market cycles can lead to cost savings, and understanding regulatory environments helps investors navigate potential risks. Through careful market research and valuation, investors can make informed, strategic choices in real estate.
Dana, you mentioned that oftentimes the best investments are not necessarily in your backyard. How do you go about finding good opportunities that are not close to home?
Yeah, I think you need a thesis, both at the macro level as well as the micro level. And there's two different ways to go about it. One, which I see more often with investors, is they may not have roots in the city, but somehow they know someone there. There's some sort of personal connection. So that I found to be a trend that I try to get people out of, but it doesn't always happen. What I do is just look at where are jobs, like where's job growth going to be? Where is it projected to go? What kind of industries are there? Like Fed, Ed, and Med. So basically federal government, education, and like hospitals is really important to have some diversification. If you're going into a mining town, there may be huge growth, but it's got one industry. And it's a small little town with one industry. So if that dries up, that property could be worth nothing. And so I look at kind of a macro level at like the city and county level, what is going on there. Then the second thing I do is look more at it's micro in the sense of like a neighborhood. And so typically from that perspective, it's what neighborhoods do I think are up and coming? And usually I look for like a health food store that's there. I look for a pet store. So lots of young people, walking their dogs, stuff like that. A good yoga studio. Typically that means it's up and coming. If it already has Whole Foods or the Starbucks there, it may already have had what I say would be the appreciation associated with that area. Now, I don't purchase for appreciation. It's an additional perk, but I do look for that in the area. I also recommend walking around the neighborhood to get a feel of it. Like, do I personally feel safe at night walking there? So that's more of like neighborhoods and where you want to purchase. There's so much data online too. You can look at, school ratings, crime rates. There's a ton of data there to help you make those decisions. What is the renter versus home ownership rates in those areas? What is the average income? Would someone be able to pay 3 times the monthly rent. So there's just a lot of variables. I put it all in Excel, or I guess Google Sheets, because it helps me objectively choose where to look. And then I go ahead and find a property which is in my buy box. One thing I would bring up, though, which I think is not being spoken about enough, is how self-driving cars may change that. And so transportation is one of the things that has been spoken about often. That transportation, when you think about solving affordability crisis with housing, if more was put into transportation, that could help solve it. So getting people from, point A to their jobs, like their home to their jobs, would help. I think with self-driving cars, people may live in different places than where they would live otherwise. If their commute was suddenly reinvented, where they could watch a movie during their commute, they could have a latte, they could have some sort of experience through it. And so that's one that I think in 10 to 20 years, we'll probably be talking about more. And that may impact where real estate investors go. It might be slightly farther outside of the city than they would today. But that's kind of the only factor that I'm trying to put into my real estate analysis in the future that's not in it today.
I love the out of the box thinking, looking into the future, and the observational data that you collect. And when you started out with like macroeconomic, I was thinking you must have gone to Harvard Business School.
that I did. I didn't learn that from there. I learned that by doing through real estate, but yes.
Kathy, I want to ask you, like, you mentioned places where jobs are growing and doing well. For you, what are the top 3 factors that you prioritize when you're analyzing a new market for real estate investment?
Like I said, we look for areas where there's a lot of growth coming in, and you can spot it. It would be freeway expansions, new airports, new schools, hospitals, and then being in driving distance from the employer base. And by that, I mean 10 minutes would be ideal, no more than 20 minutes. I think in Texas, you could probably go 30. They like driving there. But these are some of the main things we look for. And then within those neighborhoods, a lot of times people will say, oh, Dallas is a great market or Tampa's a great market. But there are parts of those areas that aren't so great. They might not have the new jobs coming in that area. It might already be too expensive, or there's, like we said, high crime. So really dialing into where is the expansion happening? For us, again, I'll just use Dallas. I live in California, but we invest a lot in Texas. It seems that in Texas, they just keep moving out more into the suburbs. And a lot of the employers do, because it's cheaper for them to put their factories or their industrial units or their business offices out more in the suburbs, but then the housing has to catch up. So it just kind of keeps moving out. If you can get in front of that path of progress, then you're in good shape. And then also just plain old opportunity. Sometimes you just have a situation where maybe a builder got themselves in trouble and you're able to pick up the land for really cheap, then it really doesn't matter what's happening. I mean, if you're getting the property for well under market value, then you don't have to depend so much on that growth.
Yeah, when you're finding a good price.
Yeah.
Rob, how about you? It sounded like with short-term rentals, it sounded like you were starting close to home and then maybe venturing further with vacation. What goes into your thought process?
When it comes to choosing a market, I actually do like starting in your backyard. And obviously I don't mean your literal backyard, although I actually did. I built a tiny house in my backyard and kind of ventured out from there. But like, I do think that investing anywhere from like 1.5 to 2 hours away isn't a bad move. Now, as someone that owns, I have short-term rentals in LA, Joshua Tree, Scottsdale, the Smoky Mountains, Austin, Houston. They're everywhere. And I wouldn't necessarily recommend that either. But I will say that there is, when you're first getting started, this really big roadblocker of like, what's going to happen when X event happens at my property? What's going to happen when there's a leaky toilet or a hole in my roof or whatever, right? And I think all of that, no matter what, whether the house the rental is 10 minutes away or 10 hours away shouldn't really matter, because you should have a team that can help you address those moments when they happen. But I do think that from a psychological barrier, a lot of people don't understand that getting into real estate. And so when someone's like, hey, should I invest in my backyard? I always say, you know what? Sure. If it makes you feel better and if it's actually going to help you build a little momentum in developing your portfolio, get something in your backyard, because I think that just kind of eliminates the biggest fear, which is like, what happens when, something crazy goes down at my rental. Now, what I actually look for whenever I'm investing in properties, 4 kind of key things. I like to invest by national parks and state parks. I think that I call these Mother Nature's Disney World and Disneyland. You don't need to market the Grand Canyon. You don't need to market the Smoky Mountains. You don't need to market Joshua Tree. Millions of people go to national parks every single year. Millions of people go to state parks every single year. The foot traffic is there. So from like a rental standpoint, I know that it's going to work. I also really like investing in vacation destinations. So these are going to be, lake towns, mountain towns, ski towns, beach towns, resort towns, big ticket places where people will spend a lot of money to stay at your property every single year, right? Families save up $10,000 to go stay at Destin for a week in Florida every single year. That to me produces relatively high profitability for my properties. And then the last one, I like eclectic towns and pit stop cities. So these are small towns that have like a draw to them, or a town like Waco, a pit stop city to me. It's a stop between Austin and Dallas. It was made popular by Chip and Joanna Gaines. People go there on the way between 2 big metropolitan areas. So for me, national parks, state parks, resort towns, vacation destinations, and then like pit stop cities are kind of my main considerations.
Do you ever buy sight unseen, or is this a matter of someone's got to go to this beautiful place to scope out investment properties? Someone's got to do it.
I would say I mostly buy sight unseen.
You do?
Yes.
Oh, how do you do your search?
So, typically I find stuff just like everyone else, right, on the market. But really the key for buying sight unseen is having a realtor that you can trust. And so I really need a realtor to make videos and kind of tour the property and FaceTime with me. But they just need to be annoyingly detailed in terms of catching every single thing that might bother me. And they need to flag anything that might be wrong with the property for me. And so if I don't feel like I'm vibing with the realtor and they're not able to get me information in a clear manner, I just will move on to the next realtor, right? So I think for that, you just have to have a realtor that you can really trust, and then even like a handyman or contractor that can go out to your property, assess it before you buy it as well.
Right. And then because you're managing them yourself, you need to have those trusted
exactly
service providers too.
100%. Yeah, I call them the Airbnb Avengers.
Justice League.
Yeah.
Joe, can you talk about, share your insights on how market cycles influence your buying decisions, and maybe especially for commercial real estate?
Yeah. So first of all, on the macro level, like everybody mentioned, jobs. Whether it's residential, people need jobs to pay the rent, or it's commercial, then those business owners need clients, and those clients need jobs to buy stuff at their stores. So we're looking at jobs. We're looking at what drives the jobs. Like was mentioned earlier, it cannot be a single industry kind of town. And that's really where we like to look at. One of the tricks we use is we find the local news outlet, whether it's the local Fox or ABC or MSNBC or so on. We'll look at all of them. And we're trying to figure out, over the last year, look at all the stories. Is there a theme there? Is the theme about growth and construction and they're open this location, this employer came to town? Or is it about hunger and need for social services and crime and so on? So we're trying to get the quality side of things from the theme that we see in the news outlets. That's one way to kind of we judge a market. And then on the local stuff, the real estate agent is going to be a great partner, especially if you're not in your backyard. Because one of the biggest things about real estate is that we have one of those weird things that I call it invisible walls, where on this side of the street, this house is worth $600,000, and across the street, it's $400,000. And same lots, same builder, same vintage. Just there's somewhere a difference in there. Maybe it's a different school district. Maybe there's a HOA here, no HOA over there, and so on. So finding the local expert that can help you identify those things is definitely a big differentiator. So if you're a real estate investor and you're working with a real estate agent, first question I ask is, well, do you invest in real estate yourself? If the answer is not yes, find one that does.
That's a great tip. Yeah, I'm definitely hearing that this is a people business in addition to being able to do your research and manage a spreadsheet. Let's go on to segment 4.
Legal and regulatory considerations are critical when investing in real estate. Contracts, whether for buying, selling, or leasing, must be well drafted to protect all parties involved. Real estate laws, from zoning to environmental regulations, require strict compliance to avoid legal issues and fines. Property taxes also affect profitability. It's essential to understand local tax rates and exemptions, as well as to monitor assessments to ensure accurate tax payments. Due diligence, including thorough inspections and title examinations, helps uncover any hidden liabilities before purchase. Title insurance offers protection against future claims on property ownership, securing your investment. Zoning laws dictate permissible property uses, making it vital to understand local regulations before purchasing. Landlord-tenant laws cover lease agreements, eviction rules, and maintenance responsibilities, which are essential for a smooth landlord-tenant relationship. By staying informed and compliant with legal requirements and engaging in due diligence, investors can safeguard their assets and ensure their ventures are both profitable and sustainable.
Kathy, what are the most common legal pitfalls that you see new investors encounter in real estate?
Oh gosh. Well, in California, there's all kinds of things you can do wrong. So one would be not following landlord rules. We've heard of people literally going in and inspecting their property without telling the tenant. So you've really got to make sure you understand the landlord rules of your location, and every area might be different. That's why we kind of prefer to use local property management companies. But if you've got software that can help you with that, that's great too. And then I would say legal pitfalls, my goodness, not reading your contract correctly, not disclosing. You've absolutely got to disclose any issues that you know with the property if you're selling.
How about you, Dana? Does Hemlane offer tools for that?
Yeah, tools, but also people on the ground. So I think it's really important. One, a real estate investor, unless you're an attorney yourself, will not know all the ins and outs of rent control and what the allowable amount is to charge for late fees. And so we try to take all of that burden off of you. I think if you think about real estate where it goes wrong when it's a tenant occupied unit, it's either one, you didn't do your diligence on finding and placing the tenant, made that mistake very early on when we fired a property manager, and the property manager didn't run the background and credit check. But making sure, one, that you place a tenant who's qualified for the property, and then two, that you have the contract in place with everything written in it. There should be no ambiguity. There should be no emotion attached to managing rental properties. If a tenant is smoking on premise, you should just be able to refer to the clause that says no smoking on the property per the legally binding contract that we have signed, mutually signed. And so I think there's a lot that goes into the day-to-day management on if you have a tenant in the property for 6+ months, usually it's 12-month leases, it's a lot more passive. If you're doing Airbnb, it's slightly different. It's more hospitality, a hotel business, so much more turnover. But I think from that perspective, like a huge lesson learned is like make sure that you have the right processes in place, because if communication is really strong, you have the right processes in place, you're objectively handling everything based on what the lease says and what the application says, it's going to just save you so much time in the end. That makes it such an easier process downstream.
Joe, this segment talked about property tax considerations impacting profitability. What's been your experience where you are in Texas?
Yeah, so just kind of before that, I want to repeat something Kathy said a second ago. She said, read your contract carefully. And I'd say, read your contract. It's shocking how many people, and in commercial, we're talking multi-million-dollar contracts, and they don't read the contract.
Yeah.
And read your contracts, understand what you're doing, understand what you're getting into. It's important. As for the taxes, Texas is a non-disclosure state. So that means when you buy a property or sell a property, we don't have to tell the state or the county how much you paid for it. And we do everything we can to hide it, and they do everything they can to figure it out. So if you buy a property in Texas, about a couple of weeks after you close, you're going to get a very official letter from the county. And please fill up this form. And they ask all the questions, including how much you paid for it. And in Texas, you can take that form, throw it to the trash because it's non-mandatory. It's an optional thing. So by not telling them how much we paid for it, now they have to estimate or assess or guess at best how much we paid for it, so they can put a new assessment on your property every year. On the larger properties, we hire a company that does that for us every single year. We're going out and we're protesting the taxes, which means there's somebody that their job is to go and say, nope, you got the wrong value. It's a lot lower than that, so we can pay less taxes. And some years they save us tens of thousands of dollars, and some years not so much. Something that came out recently in the last couple of years on the residential side of things is AI-driven companies that basically use AI to do the same amount of work, just a lot shorter and a lot simpler with single family, because it's a lot easier in the single family world. It's based on comps, and most single family properties are going through the MLS, and the MLS is kind of twisting your arm to put the sale price in there. So all that information is out there, and AI can easily generate all the protest forms and all the protest arguments with the comps. And we see that growing a lot in the last couple of years.
Wow, that is crazy. I need that guy to help me appeal my own real estate, my property tax in my house after doing some renovations.
Yeah.
Rob, any unique legal challenges that you've encountered with your short-term rentals?
I would say probably mostly just going to be on the permitting side of things. Short-term rentals are really interesting because they're kind of like the black sheep of real estate. They kind of get all the attention. They're the most hateable asset class within real estate, I would say. And they certainly get the most attention with regulations. So I would say like that is one thing where the short-term rental side kind of differs, is like you could buy a long-term rental pretty much everywhere. As far as I know, I don't think there's any place that is outlawing long-term rentals. I know that actually recently Myrtle Beach has talked about maybe outlawing all long-term rentals and keeping it like a short-term rental kind of paradise of sorts. But on the short-term rental side, every single city is very uniquely different. There are permits and processes that you have to do differently for every single city. So I think it's one of those things where short-term rentals require such way more intense studying and due diligence than your typical long-term rental, just to make sure that you can actually even operate in a specific city.
Yeah, that's a great point. I have a sister-in-law and brother-in-law in Hawaii, and they have an Airbnb that they rent a house. And yeah, they've had issues because the hotel lobby is pretty strong there, that are impacting the rules and regulations. So because we're pushing on time, and I know that some panelists have to leave, let's go to segment 5. We're going to bring it home.
Effective property management is key to maximizing rental income and ensuring long-term profitability. Thorough tenant screening is a critical first step involving background checks, credit evaluations, and reference verification. This helps secure reliable tenants who pay on time and care for the property. marketing plays a vital role as well. High-quality photos, detailed descriptions, and leveraging online platforms can attract quality tenants quickly. Routine property maintenance, including regular inspections and preventive measures, keeps the property in good condition and reduces costly repairs. Upgrades like modern kitchens or smart home features can further enhance property appeal, potentially justifying higher rents. Technology can streamline management tasks too. Property management software automates rent collection, maintenance requests, and tenant communication, improving efficiency. Smart home technologies, such as keyless entry, add value and appeal to tenants looking for convenience. By combining strong tenant management, effective marketing, regular maintenance, and technology, property owners can boost rental income and maintain property value over time.
Kathy, before you have to go, I wanted to ask you what your process is for the tenant screening to ensure that you get good renters.
My process is I work with property managers. So I let them do that for me. They're the ones who are going to be managing that tenant. They have their screening process. They're somewhat different in the different areas, but we expect background checks, obviously credit checks. I have heard people who manage their own properties will sometimes walk the potential tenant out to their car and see the condition of their car to see if it's messy or not. But basically, we do trust our property managers to keep it more of a passive investment.
Oh, that's great that you can lean on the property managers to do that. Dana, your thoughts?
Yeah, obviously being in property management and helping manage 28,000 rentals, it's the same process across the nation. You have to cross your T's and dot your I's on everything. Now, the state laws and the county laws are going to be slightly different, but it's essentially the same process for long-term rentals. Most costly expense is a bad tenant. And then the second most costly expense is vacancy. And so you're obviously wanting to balance those and really make sure, is my property listed everywhere? Am I being too restrictive or not on my listing with things like pets? And have all this objective criteria. And we help you at Hemlane, we help investors through that entire process. And then making sure you have showings right away, showing 7 days of the week. The most popular day for tenants to visit a property is actually Friday morning. It's when we get the most number of bookings. I used to think it was Saturday and Sunday based on my own personal preferences. And then everything from the lease agreement, from the application, the background credit check, landlord verification, income verification, and then going into for the property management side, it's a very streamlined process that you want to go through for it. And then obviously there's optimizations you do with it. Everything from troubleshooting repair requests to not send out a vendor just to realize the tenant could have fixed the issue on their own. Everything from troubleshooting repair requests to making sure that you do lease renewals at the right time and things like that. There's those tweaks that go through the process that can help you. But overall, I think it's a very standard process that you want to go through, and you don't want to stray from that process, and having the objective criteria in place, and then obviously following the standards that are outlined in what qualifies to move into the property, as well as after a tenant is in there, what the lease agreement states.
And then, do you think technology can play a role in predictive maintenance to help reduce overall repair costs?
Yeah, 100%. And we've already seen that, especially if you have access to every single appliance that is in the home and how old their HVAC is and things like that. You can use that to help first just with understanding predictability of repair requests versus when you need to replace something. And then as far as the maintenance and preventative stuff, there's really cool technology out there. I used to work for a company called Nest, and that's obviously home technology, thermostats and cameras and stuff like that. But there's other things that you can put on water heaters and on your appliances to know, is there a leak? Is this about to fail? And so I think that technology is just going to get better and better throughout the process. Same with keyless entry. So I think technology can really help. It's how technology works perfectly with people so that technology does what they do best and people can jump in with what they do best. And I think trying to balance those is something that a lot of tech companies get wrong because they try to automate the whole thing, or they just throw only people at it and people make mistakes. So if you can get the two to work seamlessly together, then you have a winning strategy.
Rob, your experience, are you leaning on Airbnb or VRBO for the bookings and vetting the guests?
Yeah, for sure. I would say primarily there's a new shift in this market though, which is the direct booking shift. And I think a lot of hosts are starting to ditch the OTAs, the online travel agencies, and starting to try to book directly and having the guests communicate with them directly and just handling it one-on-one. This allows you to cut the fees down for both sides dramatically. And I would say it overall creates a better experience, but it's kind of newer territory. I think a lot of hosts are scared to do it because they're scared of the risk or the liability. But this is kind of like the new big thing in the short-term rental side of things. So I'm starting to doing a lot more direct bookings.
How do you do that? You have to have your own website so people can find you?
Yeah, exactly. Yeah. So you just create a website that kind of looks like it mimics that of a OTA, that of an Airbnb, and people can go and browse your properties and then click and either book or click and reach out to you via email, and you set it all up that way.
And I'm sure that the longer that you've been doing this, at least you have potential for repeat guests and referrals.
Well, that's the secret sauce, right? So I think that's the part that a lot of people don't really keep in consideration is data collection and email collection. And there are definitely different tricks and things that you can do to collect the emails of all of your guests that stay at your property. If you can import those, I mean, for me, I've got 40 properties. Like I said, I've hosted tens of thousands of people at this point. I could have a 15, 20,000 person email list there alone. And if I could get just 5% of them to come back, that compounds over time, and really it could get to the point where all of your bookings come directly versus having to rely on Airbnb and Vrbo, which, by the way, I do like those platforms. So this is not me biting the hand that feeds me, but it is good to diversify.
Yeah, it's nice when you get a direct and you increase your margin a little bit.
Exactly.
Joe, your thoughts?
Yeah, it comes down to vetting. Working with a property management company can definitely help solve a lot of those questions and a lot of these things. Super critical to know your state laws and your local laws. What can I do? What I cannot do? What can I ask? What I cannot ask? Like California has some really weird stuff. Like Oakland just came out, I think, last year with you can't even ask about criminal background. So knowing what is going to be allowed and not allowed is critical. Property management company, that's their job. They're going to have to figure it out. But don't just pick anybody off Google. Get referrals. Ask for customers that are working with them that are happy and ask how they feel about their work. In our world, when it comes to commercial, non-multifamily, it's a lot easier than dealing with fair housing and all that. On the multifamily side, we have to deal with fair housing. Every landlord that has more than a certain amount of units have to comply with fair housing. So we have a written criteria that we share with all of the applicants. We have a very specific, predefined process. The application looks the same. The criteria looks the same for everybody. And nobody mentioned Section 8 and voucher programs. But if you have a rental, and I heard a lot of people get excited over Section 8, which is a whole different kind of headache if you ask me. But they have a whole set of rules of their own. So if you're going to do Section 8, definitely learn what they allow, what they don't allow, what they require before you jump into the Section 8 pool.
Yeah, in the segment, it talked about upgrades like modern kitchens and doing things to enhance property appeal so that you can get higher rents. I know that you've done some really creative things at some of your properties. Can you talk about that?
Us?
Yeah, I heard that you've like given away a flat screen TV or something.
Yeah, so really, it comes at a certain point where certain technologies becoming a standard. Some technologies bring liability with it, like when you have electronic locks on the door. Now you have to keep logs and who walked in, who walked out, your maintenance, and so on. So that kind of requires some things to deal with. But we love introducing whatever we can technology. All of our applications are online. All of our online payments are online. There's a resident portal. We have a 24-hour automatic voice messaging that they can create their work orders. So we try to employ as much technology and use as least paper as possible. What you're referring to is every Black Friday, I usually go out and I buy a bunch of LED TVs. It used to be LCD TVs, right? Because they became so cheap. And what we'll do is we'll create a contest or something like that will get our residents. We try to incentivize behaviors. So if we can get good behaviors and good engagement and a feel of community, just by leveraging those opportunities to buy cheap television and giving them away, then that's something we like to do, and makes everybody happy, because everybody likes TV, even if they have 4 in their apartment.
Everybody wants to win a TV. Well, I want to thank the panelists. I don't know if anyone wanted to share a final thought or not. I know that people
go buy real estate.
Yeah.
All right.
The best time was back in 2010, and then the next best time is now.
Perfect. Well, thank you. This has been a very insightful discussion. A big thank you to Kathy, Joe, Dana, and Rob for sharing their expertise and real-world experiences today. I think one of the biggest takeaways for me in this episode is that real estate investing really is incredibly versatile. Whether you're aiming for long-term wealth with buy and hold, or you're looking to flip properties for a quicker profit. Some people may, I think not in this group, but some may want to own like REITs, which are stocks, as a strategy. But I think not quite the same thing as owning a physical property. The key is to align your strategy with your financial goals and your personal involvement level. For a call to action for our viewers today, I think just take a moment to evaluate your own investment strategy. Is there space for real estate? Do you want to be hands-on or hands-off? Do you want immediate returns, or are you looking for long-term growth? Clearly, I think that real estate does require patience and learning, and as we heard today, building your muscles and building your resilience. So jot down your answers and identify one action you can take to get closer to your real estate goals. Maybe it's researching local markets, exploring financing options, certainly talking to as many people that you can learn from, and creating a network of people to share knowledge. Don't forget, if you haven't done it, head to inspiredmoney.fm/getplan to do your 3-minute financial plan. I encourage everyone to follow our panelists and get more. If you want to learn, you can find Kathy Fettke. She's CEO of Real Wealth Network. Also check out her book, Retire Rich with Rentals. You can find her at realwealth.com. Rob Abasolo is Rob Built. You can find him at robbuiltchannel.com, or look for him on YouTube. He's got really great videos. Dana Dunford is CEO and co-founder of Hemlane. You can find her at hemlane.com. And Joseph Gozlan is a commercial real estate broker and investor. Check out his book, The Real Estate College Fund. You can find him at ebgtx.com. Thanks again for joining us, Inspired Moneymaker. We're going to be back next week. Our episode is The Power of Philanthropy, Making a Difference Through Charitable Giving. That is October 30th at 1 p.m. Eastern. Thanks everyone for joining us. A shout out to our panelists. Thanks to producer Bradley for editing the segment videos and helping with the planning. Until next time, do something that scares you, because that's where the magic happens. Thanks everyone.